Everybody, welcome. We really, really, really appreciate you. I see we have a lot of people on the call today visiting us from all throughout the US, and that means a lot to us at Excite Capital. I am Dr. Julius Oni, CEO at Excite Capital, and I'm super excited to see the interest that that this deal has generated. I'm super excited to see you all here, and my hope is that when we are done with this conversation today, that you will see exactly why we are extremely excited about this deal. And you would see exactly why I've said since we got this deal that if I had all $22 million that we had to raise, I'll probably be willing to put it in. The only reason why I wouldn't put it in would be because I like to still share, some goodies. So if not, this is that type of deal that I am very, very comfortable betting everything I've got on. So, but it's important for us to go into the details so that you also can by yourself come to the same conclusion. So this deal that we are talking about today is the Grove Parkview apartment homes in the Atlanta, Georgia metro statistical area. You're going to hear me talk about the Grove Parkview multiple times today. But before we go into discussing it, I've got to give the disclaimer. The only thing I'm board certified to do or that I'm licensed to do is to replace people's hips and knees. So everything else that I'll say here today is said with the intention of educating you about this deal and so that you can make the best decisions for yourself. I still want you to do your research. Definitely feel free to double check any facts that I'm sharing with you today. Talk to your financial advisors to make sure that this is a good fit for your portfolio. Getting right into it. So, Excite Capital Investment is always bringing this deal to you today. An Excite Capital Investment is made up of just three people: me, Leslie Awesome, and Tanny Tolofari. And really, why did we even start in the first place? you know, Leslie and Tanny were friends, and Leslie and I were co-workers. We were taking care of people. I was operating on them. Leslie was putting them to sleep. And anytime, we were waiting for maybe cement to harden when we were doing total knee replacements, Leslie would, me and Leslie would just talk about business. Maybe at the end of the day, we'll talk a little bit about what I was doing with business. At that time, I was doing a lot of angel investment. I also had a small single family portfolio. And Leslie would tell me about these investments in real estate. At that time, he had a condo also that he had renovated and it was renting out and things like that. And we would just talk about all business in general. And at some point, the conversation came about multifamily real estate investments, and I just didn't think it was possible when Leslie first told me about it. It's like, I'm not sure about this. Like, how are you telling me that we can go buy millions and millions of dollars worth of properties? I thought maybe you were smoking something, but very quickly, I definitely internalized it. I just didn't act on it at the time he was telling me. And then COVID happened, and I had like tons of times at home. I was just, walking in the woods for the most part, seeing patients virtually, and for the first time in a long time, I started to realize that, man, this job that we thought was so secure may not be that secured after all. And obviously, that COVID in general was just the pandemic was a time for a lot of us to rethink what we thought was possible. And I was no different. So I started reading more about multifamily real estate. I started listening to podcasts. I started, engaging with some of the material that Leslie had shared with me on real estate. So quickly, I saw the light. I realized that, I lived in this apartment when I was in undergrad. I lived in this apartment when I was in medical school. I lived in this apartment throughout my training process. And the people that own the apartments, they definitely do not have two heads. And so I was like, why can't we do this? And so we started to go to conferences together. Oh, by the way, I called Leslie and Tenny after making that realization and said, listen, I want in, and from that point on, we became 1/3 partners and equal partners in this. And so we started going to conferences, going to different events where real estate was being discussed. And I saw something that was very clear. I saw that one, there was a significant, um, uh, um, uh, there was something that was missing. There weren't a lot of healthcare professionals in these rooms. There were a lot of business people, a lot of lawyers, a lot of engineers, a lot of, you know, um, other folks with different backgrounds. I didn't see too many doctors or healthcare professionals. And also, there were not that many underrepresented minorities represented in these rooms. So quickly, we realized that there was a great opportunity for us to take the gospel of multifamily to people like healthcare professionals of all backgrounds and underrepresented minorities of all professional backgrounds. And that is exactly what we've done for 5 years or 4+ years. And we are so excited that in the last 5 years, so 4.5 years, Excite Capital has been able to acquire $168 million worth of real estate in collaboration with our community of investors. Without many of you on the call, without other investors just like you who have believed in us in the past, we wouldn't be here. And the way we've only been able to do is we've got a great group of people who says, you know what, we believe in this vision too. We also want to be co-partners or co-property owners with you, and we've all pulled our resources together. That's the only way we've been able to buy 6 different apartment buildings in the last 4.5 years. So across our portfolio, we have an average occupancy of 92.7%, a total income of over $260,000 a month, and average operating expenses of a little under $106,000 per month. We have an average net operating income of $154,725 per month, and till date, we've distributed over $7.5 million. And we are once again only able to do this because you and others believed in us. So I stand here super proud of what we've been able to accomplish so far. But I am particularly even more proud because right now, I believe we have the best deal we have ever brought to our community of investors. And I will tell you why. So Excite Capital is super, super excited to present to you the Grove Parkview property, a 268-unit property that's located in Stone Mountain, Georgia, just right outside of Atlanta, located on 19.6 acres of land and built in 1989. The average unit square foot is about 864 square foot, and the average market rent right now is $1,603. It's currently 96% occupied. So this is just a nice little summary of the offering of what we are offering today. That we are going to go into a lot more details with it as we go into this presentation, and as we also go into the questions and answer section of this. So the cap rate, adjusted cap rate, T12 cap rate is 4.92 going in, And once again, the occupancy is 96%. The expense ratio at this point is about 49%, which is relatively well managed. The DSCR is 1.32. For those that don't know, that's the debt service coverage ratio. Anything over 1 is great. That means after paying the mortgage and everything, there's still much more left to do many of the things that we need to do on this deal. And one of the beautiful things about this deal is that we are assuming a long-term debt that already exists on the deal that is already at a 4.74% interest rate. You cannot get that on the market right now. So this is wonderful in the sense that if we were to get a new loan right now, we cannot get that rate. And we still have a fantastic long runway with that rate. We are projecting that the limited partners will end up with at least a conservative average annual return of between 15 to 18%, and with equity multiples of 1.5x to 1.8x, with the old time of about 5 years. And I would explain to you why this offering or the return metrics are super conservative. If you know anything about Excite Capital, we are well known for our super conservative underwriting, and this is no exception. We've underwrote this very conservatively with the expectation that we are going to underpromise, but we look forward to over-delivering for you, our group of investors. So with these deals, what we do is we get into them and then we start to improve things. You know, we take care of some of the deferred maintenance. We start to turn some of the classic units, meaning we renovate them, and then we are able to generate more income on these properties. The name of the game is net operating income. Net operating income is determined by the difference between the revenues generated by the deal and the expenses on the deal. So if we are able to increase the revenues, fantastic, increases the net operating income. If we're able to manage the property better and decrease the expenses, once again, we increase the net operating income. That is kind of what we do. So the exterior business plan, this is outside of the property. We plan to upgrade some of the residence amenities, and make the pool area look nicer, put in a dog park, and also put in a play area for the kids on the property. And this is going to cost about $800,000 just doing all of those things. With the interior plans, we plan to spend an average cost of about $14,000 per unit to renovate over 100 units over time. And with this, we plan to improve the quality of the kitchens, the bathrooms, and the unit flooring. And we already have proof that with this same renovation plan, or even a slightly worse renovation plan that's not up to par of what we're trying to do, they've been able to generate significant post-renovation market rent, as you see there. So anywhere from $40 to $410 is the rent premium that they've been able to generate on this property. So when we are done with this value add plan, our promise is that we're going to be able to increase the value of the property by over $19 million. So $19,622, $490,000. So $490. So that is our goal here. That by the time we are done implementing this business plan, doing the exteriors, doing the interior, that we will be able to increase the value of this property by close to $20 million. And this is the floor plan of the current property of the property as is. One of the things that I want you to notice right here is, I'm not sure if you guys could see let me see if I could get an annotation here. So this studio right here that you guys see, that studio is 711 square foot. The one bedrooms, if you guys could see, is 729 square foot. So these studios are almost the same size as the one bedrooms. And you can see the bedrooms in the studios are completely separate from the great room. So one of the things that we're also thinking about doing, there's 19 of those 711 square foot studios. We are also going to convert those to one bedrooms. And guess what? We did not even underwrite that as part of our business plan. That's just, and if you're able to convert those studios to one bedroom, now you actually can generate even more income because now you can rent them as one bedrooms. But because Excite Capital likes to be conservative, we did not even include that as part of our of the business plan. That's just the extra. That's the icing on the cake. Those are the types of moves that takes us from what we promised to something unbelievable. Just like the property, the view that we sold. Let me just go back to that. Let me go back to that property real quickly. Look at that. All the annotations are like let me just try to delete all annotations, clear all drawings. Yeah, there we go. So I'm just gonna quickly go back to the property that we sold there, the view at St. Andrews. We had promised 18% on that particular deal, average annual return. We were able to deliver almost 30% average annual return to our investors. The reason is because of things like what I just discussed with you, like, all of the different cushions that we've built into the deal with our conservative underwriting. That's what's going to allow us to overperform on this particular deal. So this is the Grove Parkview here. The average home value close to that property is about $480,000. The average home value. I mean, it's close to everything from Chick-fil-A to Amazon distribution centers to, all kinds of stores like Walmart, Staples, Walgreens. It's close to some of the best schools in the area, which we will discuss later. So there are three ways as an investor that you can invest in this deal. One is as a Class A investor. And by the way, typically before we only did one class. Usually the Class B is what you would see us do for the most part. But many of you, our investors, have come to us and say, you know what? Why don't you introduce give us a few more options so that we can also be incentivized to invest alongside what we want. So for Class A investors, those are the investors that say, you know what? I don't care about the upside of this deal. I just want to make a flat rate when it comes to return, and I don't want to participate in the profit. For those investors with a minimum investment amount of $100,000, they get 10% average annual return, or cash flow rather, on their investment every year of the business plan. So in those 5 years of a hold, these people will end up with $150,000, if that makes sense. With Class B investors, by the way, Class A investors, obviously, because they sit on higher on the capital stack, over the rest of the Class B and C investors, because they are not participating in the profit share. Class B investors are the classic investment vehicle for most people. The minimum investment amount is $50,000, and you will have a 6% preferred return that translates to the cash flow, and then an 80-20 split profit share, with 80 going to the limited partners. That's you who is putting your money in. That's the limited partner. And 20% goes to the general partners. There's the group of us that are putting this deal together, making sure that we're implementing the business plan. The good news is This deal is structured in a way that, one, we as general partners always have skin in the game. We always also invest alongside of you. That's one. Second, we have structured it so that we are incentivized to overperform for you. As you will see with the hurdle structure later, if we are able to get you to 20% average annual return or more, then then the waterfall splits and this becomes 50-50, because that really encourages us to overperform for you. And for Class C, those are big check investors. Some of our investors that bring in $750 to $1 million worth of capital, also wanted to be able to, like, be incentivized to do that. And so the way we've done that is we've changed the profit share for them, and they get a tiny little more preferred return, but also get a bigger piece of the deal. Because obviously, as I think everybody on the call would agree with me, that if you bring in more capital to the deal, you should have the right to gain a little more and almost, participate almost like a general partner. So this is the investment offering. This is the capital stack here. So the debt obviously gets paid first, right? And then the Class A investors come next on the capital stack, and then the Class B and C investors. And after that is where you could put the general partner. The general partners is kind of last on the capital stack. Everybody needs to get paid first, and then we get paid. And so this is just a summary of what the return metrics look like in the form of equity multiples and the average annual returns for each class. And we could go into more details about that later. Because of the way this is structured, the amount assigned, LP, the limited partner equity assigned to Class C is limited. It's only $6 million. Class A is only $2 million. Once we fill those up, everybody would have to either come to Class B or nothing else. But so in Class B is only also a little over $14 million. So this average annual returns, just like I said earlier, particularly for Class B and Class C, the folks participating in the profit share, that is, I mean, that's the floor, I believe, of what we can do on this deal. I'll show you why later. So once again, the waterfall structure, this is 16% IRR for Class B, or 18% internal rate of return. That usually translates to a higher average annual return. So once we hit those return metrics, then the profit share goes to a 50-50 split. This incentivizes us as general partners to overperform for you. If you're making 20% average annual return on the deal, we should have a right to also do much better on the deal also. Awesome. So this is just a little overview of what I just want to highlight a few good things about this underwriting. So the vacancy that was trailing for the last 3 months before we put this property under contract was, for example, 2.7%. Guess what? We could have underwrote it as that, but no, we are projecting a 6% vacancy throughout this deal. And that what that means is that we are projecting that we're going to, because if you obviously have 3% less occupancy, that's less revenue coming in. That's being conservative. That's saying we don't expect to be full like that. We want to make sure that we are testing the market and making sure that we are right in line with market prices. We don't want to be over it. We don't want to be under it. Same with the trailing 3 months or effective gross income. It was over 5 million. So guess what? This is, I mean, when you project out what the income would be, over a year, based on what the property has done in the last 3 months, it's over 5 million. But guess what? We love to be conservative. We put in less. Like we put in about almost $200,000 less as our projection for the first year of being on the property. This is what I'm saying about, we don't even get to that point until the second year of the property. So just to kind of let you know what the way we underwrite this deal. We are super conservative, and this is the secret to our success. This is why when everybody else was doing capital calls, when deals were falling apart and people were getting foreclosed on, even though we bought deals at the same time as many of those people, we at Excite Capital are proud to say that, one, we have not had to do any capital call. And thankfully, we have also not foreclosed any deal. So we are very proud of that metric. Yes, in some cases, we've had to pause distributions just to shore up reserves, but the value of those properties continue to go up because the net operating income continues to go up, and the investors are gonna all be made whole eventually. But that's the beauty of this, is that we stay conservative so that we can, one, preserve your capital or preserve your principal, and second, help you grow your wealth. This is the debt financing. We are not very leveraged on this deal. This deal is, we only have a 64% loan to value ratio. I mean, that means we are bringing the balance of that, so this is not a deal that is like 80% loan to value ratio where there's like significant leverage on it. So that really protects the deal too over time. And so this is the loan amount is going to be just a little bit over 31 million. And yes, this is a sensitivity analysis that we love to do, to essentially say that, you know what, we are projecting that we are going to exit this deal at a worse cap rate than we're going in right now. Every projection of any expert is that as the interest rate starts to drop, cap rates are going to start dropping. And actually, one of the foremost authorities on projecting these cap rates is CoStar. And CoStar is projecting that at the time that we are going to exit this property, the cap rate is going to be 4.6. If we had projected that, what the experts are saying, we will be telling you that your average annual return will be 23.52%. You will be making 2.18x on your equity, and you will end up with an internal rate of return of over 17%. But we at Excite Capital don't like to do that. We like to project that things are going to get worse. That's what we are assuming, that even if things get worse, what can we project? What can we produce for you? And so I am pretty confident that if the experts are to be believed, and if history is to be a predictor of the future, that most likely this is where we're going to end up. We're going to end up closer to the cap rates that were projected by CoStar, if not better. And that was for Class C. This is for Class C, Class B. This is for Class C. It gets even slightly better for those big check investors. So once again, the market has excellent fundamentals, particularly Gwinnett County. I'm not just talking about Atlanta in general. When you look at Atlanta in total, the projected rent growth is all over the place for, when you compare like Alpharetta or even Sandy Springs or other submarkets in the Atlanta area, they have lower rent growth projections. When you think about Gwinnett County, for anyone that knows the Atlanta market, everybody is excited about this because they know that that's where a lot of people are moving. That's where the future rent growth is happening in the Atlanta region. So 15% projected rent growth is what's supposed to happen up until 2028. Once again, some of the best schools exist in this same county. So many people actually just want to rent there so that they can be able to send their kids to the schools of this county. So the Parkview High School is one of the best schools in the state. And then bonus depreciation obviously still exists on this deal. There are $100,000 investors right now, based on what bonus depreciation we're able to do, is going to make it. I have about $27,000 in depreciation, which will offset the cash flow that you get from this deal. But if you also have other sources of passive income, you could use this to offset those sources of passive income. If you have achieved rep status, you can use this to offset even your active income and your earned income. And the beautiful thing about this is there's a law right now that's in the House of Representatives that is going through Congress that we expect that anytime from now will be signed into law, that essentially restores this to 100% bonus depreciation, which makes it that much bigger. We've really, truly, this is one of the magic of investing in multifamily real estate. The tax savings, the tax advantages of it is mind-boggling. And we could go into more details about that. We do this by doing a cost segregation study. We're doing on every single one of our properties. And then we're able to pass all the depreciation to all our co-owners. Everybody on the property ownership group gets their share of the depreciation based on the amount that they invested. Our property manager on this is Asset Living. They manage over 285,000 units from coast to coast. We've worked closely with them over the last several years. We trust them. They work closely with us, and we are super excited about it. And another thing about property management, the folks that live in this building, that actually live in the building, that are going to be managing this asset for us. The folks that manage the building currently, the property currently, they've been there for so long. I think they have a combined 75 years of being there. I think the property manager, the lead property manager, she's been there for 25 years. The next person has been there for about 15 years. And when you think of like the top 4 people on the property, they've been there for a total of 75 years. So this is a property that they love very dearly, that we were talking to them and they were saying they can't wait to like manage it with us. They are super excited to do it. And they just have so many stories. There's like a lady that's been living in this property for close to 25 years. And she was, when we went over there to visit and we were talking, she was telling us about how children went to the same schools in that same district, and how she was only able to send children to those great schools because she was living in this property, and she just loves it. I mean, the property managers were telling me that she actually doesn't even let them do the upgrades that they usually do. And when we looked at a unit, it was impeccable. These are people that love this apartment building, and we cannot wait to love on this building also, just like them. So this is the property that I was talking about, the view that we just, because some of you may be saying like, you're saying all of this good game. Like, have you ever done this before? Have you actually taken a property from buying it to selling it? And what have you done with it? Well, guess what? We purchased the view. At that point, it was Churchill at St. Andrews, and the before look there, that was the building, then the signage for the property. And by the time we took it over, we changed the signage, we made it more spunky. We even got an award for a beautification award. because we completely transformed this community. And we were rewarded for it because we were able to send an average of 7.1% in cash and cash distributions to our investors on this particular deal. And 21 months later, we were able to sell the deal for $17.8 million after buying it for $12.55 million. So we were able to essentially deliver almost 30% average annual returns to our investors on this particular deal. And that's because we underwrote conservatively, just like we have on this deal. We implemented the business plan just like we promised, and we were able to over deliver for our investors. So the timeline, if you're thinking, okay, Julius, you have said enough. I just want to dive in. Let's go. Let's do this. Well, we have this particular conversation that we're having today is only actually just for our investors. We've not made this public yet. So we actually want to make sure that those people that have been in our community that have really been super kind to us, of being showing up to our meetup, of what we're doing, we want to make sure that they get the first opportunity to invest in these deals before the rush that is sure to come once we make this deal public. So the first people that got access to it were the people on our hot investor list. We have a list of people who are saying, as soon as you have a deal, I want in. I don't care, just let me know. Those people already got a chance to take a look at this deal. A good number of them have gone in already to the tune of about $7 million already. In addition to those people, we have the non-accredited investors. There's a lot of people in our community that say, you know what, I don't meet the definition of an accredited investor. So but I still want to, I've saved enough. I still want to be able to grow my wealth too. We were able to, for the first time in a lot of our deals, we were able to, at least the deals that we were lead sponsors on, we were able to do a 506B, meaning we could bring in a limited number of non-accredited investors onto this deal. And so that already happened. And the deadline for those guys to fund, those guys and gals to fund, will be June 27th. That's 2 days from now. By the end of this week, we are going to make this deal public. But before we do that, we wanted to come to you, our community of investors, the people already in our community, to say, you know, hold your spot, secure your spot first, and then we'll make this deal public later this week. And it will be first come, first serve from that point on. So the top timeline days for the non-accredited investors, and the bottom timeline is for the accredited investors. For the accredited investors, you have a deadline of July 31st to fulfill the subscription agreement and fund the deal by August 1st. But the subscription agreement and the operating agreement on this deal is all ready. Everything is on the platform and ready to go. This is going to be the process. You complete your investment requirements. You log into our portal. You sign the PPM and subscription document. The PPM is the private placement memorandum, and and then immediately after you sign that, you wire your funds, and then you can sit back and just enjoy your returns after that. If you are ready to go today, please go ahead and just scan that QR code that you see there. Secure your spot by putting in your reservation, and then we can move through the process. I think we already have about it's already 7:47. I would like to have people ask questions so that we can get to some of the meats and potatoes of this. Thank you for you listening. Any questions?
Job, my chairman. Yeah, we have a couple of questions in the chat.
Beautiful.
Yeah, I'm going to just read read them out here for you. Muiwa is asking, how long is the renovation going to last? And if the studio will be converted to one bedroom, will the city give approval
Usually,
easily for this?
can you hear me?
You're breaking out a little bit.
Can you hear me?
I can hear you now.
Oh man. Okay. Okay, great. So I think the question was how long is the renovation supposed to last, right?
Correct. And will the city
Okay,
give
so the rent.
approval to convert the studio to one bed?
Yeah, so the approval process is not the issue. We are very comfortable moving through, and let's remember the conversion to one bed is just an extra. It's literally the icing on the cake. The renovations of the property, that's within our purview. And usually what we do is as a tenant moves out of those apartments, we turn them. And we usually do about, depending on what our schedule is, usually about 3 to 5 of them per month. And so this is going to be going through the entire business plan. This is how we do it. We just do it every month. We are turning a certain number of units, and the next tenants that come on essentially pays the premium rent or the new rent, which is reflective of the quality of apartment that they get in. I think there's another question that Tomari was asking, that how do you plan to do this renovation while the apartment is occupied? I'm hoping that was answered with the previous answer. We do it once the tenants move out before the next tenant comes in. And I think Tosin Umueka was asking, why is the seller selling? So this is the last unit in this part of the country. They're moving the investments to another part of the country. And actually, they told us that they are very sad to let this one go. This was their golden goose. But they're changing their business plans and moving to another part of the country. So they are selling this. So, but of all of the buildings in their portfolio, of all of the apartment communities in their portfolio, this was the last one they sold. And it was really tough for them to let it go. And when you talk to the property managers on this, you can tell that this is an absolutely special property. For those of our investors that we actually invited some of our key investors to join us on the due diligence. Everybody's saying the same thing. They love it. And I think every single one of them decided to invest in this deal. And by the way, for any one of you that are on the call, if you also want to visit the property, just let us know. We make it happen. We love when our investors visit the property because it becomes real for them. That, what, I'm going to be a part owner of this particular apartment community. Tosin was also asking, are distributions monthly or quarterly? They are quarterly as of now. Eventually, at some point in the evolution of Excite Capital, we may go to monthly distributions, but for now, they're quarterly. Is there a possibility to refinance and return capital before selling the deal? That is always an option. Absolutely. I think there's always, if for example, we always testing different exit strategies, and there's always a secondary business plan or exit plan. If the right thing to do at that point is a cash out refi, which is what you're referring to, where we return capital to our investors and still keep them in the deal, and we all still try to continue to cash flow on the deal, then that's what we'll do. But what's most important to us is to be able to generate significant returns for the investors, particularly within that timeline that we've given you. So my goal is that you get a significant return within that 5 years that we talked about. At the View, we said we would do 5 years. We did 21 months. This one, I would expect to go longer than that. just because this deal is just fantastic, and we would want to milk it and really create a significant, even more significant value before we sell it. But after about a year or two of having the deal, we usually, even actually throughout the life of the deal, we always testing the market and seeing what the market is saying about what the broker's opinion of value is, so that we can always know where we are and then make a decision as to when the best time is to exit the property. Dave was asking, as you get to the end of the funding cycle, do you plan to add bridge debt if this is shortage? We do not expect to add bridge debt on this particular deal. We have multiple backup plans if towards the end of the funding cycle. If there's any shortage, we have some fantastic big check investors that have already made clear their intentions to take whatever is left. So, and they're not bridge debt; they're just investors. Yeah, we have actually partnered with them before on some deals in the past. So, they really love this deal and are local to the Atlanta region. So yeah. Onella Lemonius was asking, a bit curious about the cap rate. We are buying at a cap of around 4.9 and expect to exit at a cap of around 4.6. Absolutely not. Are we underwrote that we are going to exit at a cap rate of 5.3, Onelia? So I think you may have misunderstood me. I said that the CoStar is projecting that we are going to exit at about 4.6. Does that make sense? So I hope that answers the question. But our underwriting projects that we are going to exit at a cap rate of 5.3. Yeah, so big difference, big difference. If that's not clear enough, please let me know, Ornella, and I'll be more than happy to shed more light on that for you. Yeah, it's just the sensitivity analysis is what shows that CoStar is projecting, and CoStar wouldn't be necessarily wrong if interest rates truly starts to come down in the next few years, and it comes down enough. Usually what happens is that the cap rates also starts to compress. And usually a lot of capital sitting on the sidelines are gonna rush back in. This is an institutional grade asset. So it's not just gonna be private investors that are gonna wanna come in. There's gonna be a lot of institution money going after deals like this. So the cap rate of 4.6 is not completely out of this world at all. It's completely within reason if the Fed starts to, for example, starts to drop rates and investors rush back into the market.
So there's some questions in the chat as well.
Fantastic. Please go for it, Teddy.
Ahmad Mohammed is asking, I started the paperwork and I'm awaiting countersign. Did I fill out the paperwork too early as an accredited investor? Or I can sit back after that countersign?
No. There's still a bunch of accredited investors are also investing alongside. It's not just the unaccredited investors that are investing right now. I'm sorry if that was confusing. If you signed your subscription documents and everything, you will get the countersign very soon. I'm going to go in and start countersigning them soon. So do not worry about them. Just sign your part. Go ahead and effect the wire, and we'll get this going for you.
Also, Felicia asked, can you share the bonus depreciation for Class B investors?
We can. So the bonus depreciation is the same across the board. It's $100,000 invest and $100,000 investment with the current rules. With the current bonus depreciation that you can get is about $27,000 in depreciation. If the rules change if Congress signs the current bill into law, and the reason why this is going into is in Congress right now is a lot of Congress people take advantage of this depreciation. So the things that they take advantage of, they're going to be quick to expedite it. My suspicion is that this is going to probably pass sometime later this year, and if that happens, then and if they institute it so that it takes effect immediately, the depreciation are going to increase in this. But with the current rules, with what exists currently, it's going to be $27,000. So 27% pretty much of your investment. So $27,000 for any $100,000 investment.
Thank you, my chairman. Reginald is asking, does Excite plan to diversify into other real estates? That is warehouse and call center, etc.
That's a great question, Reginald. We, at this point, are trying to be the master of multifamily real estate first. We love to become masters of one thing before diversifying. It's obviously there are a lot of sexy objects and shiny objects out there. Industrial is one. There's self-storage. There's a few other, promising asset classes within commercial real estate. But for now, we have gotten really, really good at managing and acquiring multifamily real estate, and that's where we want to stay. For now, I would suspect that we'll probably go into development before we go into other commercial real estate.
These are really good questions. Please keep them coming.
These are fantastic questions. I love them.
And then Ahmad is asking as well, is how are so many renovations planned to take place given the high occupancy rates? Will this happen while tenants are in their units?
I think that
Hello, Chairman.
Asked them. I think it was oh no, Olatomi Tomori that asked that question. So we do not plan to renovate while tenants are in. That's not what we do. We renovate at the turn of the property. As the properties are turning, meaning as the tenants, their leases it expires and they leave, we renovate before the next tenant comes in. And it's usually an average of 3 to per month.
I think we are losing Julius there.
But it could be more, it could be less.
Yeah.
The other thing, Chairman,
are you losing me?
is no, maybe that was me. The other thing to note is that at a 96% occupancy, means we have an average availability of 6 to 7 units to renovate on a monthly basis, and which is kind of in line with our business plan.
Thanks, Leslie. Let's see
Any
if
other
there's more
questions?
question. Please keep the questions coming. We would like to answer any question you have so that we can.
While we're waiting for the questions to be asked, I think someone else was asking. Did you say the DSCR is 1.2? It's 1.32. Oh, someone already asked that.
I responded.
Oh, thank you so much. That's wonderful. Yeah, I mean, for those that are listening, I am just so thankful, one, that you are on this call, because when we started Excite Capital, a lot of people said, it was impossible that, healthcare professionals are not interested in this. They're not going to get it. You're not going to be able to raise capital from them or with them. And they say the same thing about underrepresented minorities. No, they don't get it. They're not going to. But I think the existence of Excite Capital has proven everyone wrong. That were naysayers. We have been able to, in collaboration with many of you that are on the call and many of you that are going to hopefully join us on this property, we've been able to do the unbelievable things. I mean, I can't say enough how thankful I am to this community, because it's because of you that we are able to do this. If we are not banding together like this, because I don't have $20 million to go to go buy this property, but what I know is that if we all pull our resources together, we do have this, and this is only the beginning. I see a future where we all together continue to buy these properties and buy billions and billions of dollars worth of these properties together and grow our wealth together and get this incredible tax benefits together, and just do incredible things together. This has been done before. We are not reinventing any wheel. And I strongly believe that we can do it. No questions in my mind. And I cannot wait to see you all join us in this property ownership group.
Yeah, there's one question, Chairman. Thank you for that. There's a question here from Tajundin Otun. He said, if tenants remain, does that complicate renovation schedule, thus force appreciation?
No, not at all. So just like my wonderful partner, Leslie Allison, mentioned earlier, remember, we are expecting that the occupancy on this is going to be 95%. So at any time, there's always going to be, remember, this is 268 units, right? So there's always going to be people whose leases are going up. And even if someone's lease goes up and they don't want to leave, that's fine. We'll do the next person who's leaving, right? So we don't kick people out to do our renovation plan. And there's always enough to essentially do the renovations with. And the beautiful thing about this is every month that you are part of this property ownership group, you're going to get an update. For those of our existing investors, I know you've gotten this before. You're going to get an update essentially outlining to you how many units were renovated, what the current occupancy rate is, what type of wonderful things we're finding on the properties, what kind of positive things. If there's any negative things, we'll tell you about it. And you get to review all of the financials of the property. So we practice radical transparency with this property ownership group, and we make sure that we keep you updated with what's going on the property, so that you too can start to kind of get a sense of, okay, this is what's happening in this property that I co-own. This is how the business plan is going. Is it going according to plan? Is it a little behind schedule? We will be updating you all the way through on a monthly basis.
And then to add to that, if you have any challenges going through your subscription documents, if you have any hiccup, please reach out to any one of us. Our team, not just me, Leslie, and Dr. Oni. There's a whole team members behind us that's working 24/7 to make sure each and every one of you have a seamless experience when it comes to going through the funding process. So please, if you have any questions, call us, text us, email us. We'll make sure we address any concerns you have. We've created a lot of resources to make sure that the funding process, the subscription process is very smooth. But if you have any hiccup, please call us and we'll make sure we are very accessible. The founders of the company is very accessible. The team members are very accessible. Call us, text us anytime, and we'll be able to help respond to any questions that you have.
Absolutely.
There's a question from Oluwatosin. He's asking who is doing the renovation.
Any other questions?
Can you hear me, Chairman?
Yeah, who's doing the renovations? Oh, yeah, of course. Is
it a group we've worked with before? Is the price for labor and materials quoted likely to fluctuate?
Yeah, this is a great question. I really appreciate this question, Oluwatosin. So the people, we have contractors that we work with, and they are usually working closely also with our property management group. So Asset Living, who is our property manager, they work, I mean, very closely with us, and we meet with them on a weekly basis to see how we are tracking with the business plan. So the way it works is, the property manager is there, the contractors are there. We actually own another property about 4 miles away from this one in Stone Mountain, Georgia, too, that we acquired in late 2022, that we completely transformed. And so we have a lot of relationships with contractors who are able to implement these renovations. This is not something that we've not done before. We've done this multiple times in multiple jurisdictions, but more importantly, we've done it even in this neighborhood. So we have everyone ready to go. And is the price of labor and materials quoted likely to fluctuate? Yes, they could, but we've built all of that in. So there's no questions that we don't have a magic ball. We can't predict what the future holds. So yes, labor and materials may fluctuate, but these things are very, relatively predictable over time. And so when we are doing the prediction or projections, we are putting in actual numbers from contractors who have looked at this property, come to check it out, and we can hold them to the fire and make sure that they're delivering on what they promised.
And then to Eric Peters, yeah, we're going to send the recording of this webinar to you. You can share with your partner. And if you have questions that you want us to answer, we can jump on a call with you and your partner to answer those questions as well. But yeah,
Absolutely.
we can share with you the recording and any additional information that can help you understand the deal.
Absolutely.
And then there's a question from Elvis Abia. He said, could your location outside of the States be an impediment to invest?
Location outside of the state? You mean outside of the United States? Is that what the question is?
Yes.
It depends on the location. We are working on some structure to allow for some of our investors who are international to invest in this deal also. I will hold off on giving you any definitive answer on that currently, but I can tell you that we're working on some structure to allow for our international investors also to partake in this particular deal.
Yeah, and please reach out to us. Let's discuss what your situation is, and then we'll be able to figure out how we can help you out there. And then the chairman, there's another question from Ornella. So they're asking, thank you for the clarification on the cap rate question. What factors do you perceive would impact your ability to exit in 5 years? If you have had a deal gone beyond expected exit, how do you typically handle that scenario?
Yeah, that is a great, and I love it. What factors do we perceive in 5 years? Oh, a few factors that do that. One, I mean, the Fed could just decide to continue to increase in interest rates, right? And for some reason, the cap rates continue to expand, right? But I mean, that's not what anyone is thinking is going to happen, because then the entire economy would crash if they do that. But if that was to happen, then just wait it out. We'll wait it out until things start to come down again, and then we still sell at a fantastic price. So there's a few other things that can happen. It could be that, God forbid, something like the pandemic happens again, God forbid, and transaction, volumes are down either temporarily or for a sustained amount of time. We'll hold off until, it's the right time to sell. The 5-year mark is the guideline for the most part. We hope to be able to exit in 5 years or even before that if the property if we've achieved our business plan, for example, like we essentially, if 2-3 years from now, we check with our broker to get a broker opinion of value, and they're saying, hey, listen, this property is already $25 million more than what we bought it for. At that point, we'll definitely see what we can do to maybe consider selling potentially, and at that point distribute, because then we would have completely overshot the projections that we promised you, and we can then give you the option to say, you know what, do we want to sell? Do we, we have an entire panel of people that we sit down with and like discuss and then make the best decision for the collective. But that 5-year projection is a guideline. Our hope is certainly to be able to exit on or before 5 years, or at least get you a significant amount of your capital back by that time, either through a cash out refi, where everybody still stays in the deal and continues to make infinite returns. Muyo Fakone was asking, what's the decision process like?
Can everybody hear me? I think Julius got frozen there a little bit. Muyiwa, you're asking, what is your decision process like? Do investors have voting rights? Unfortunately, no, investors doesn't have voting right. But we communicate with our investors in any decisions we're making as regards to the refinance or the sales of the property. Again, our priority for each of these deals that we buy is to make sure the investors, one, make money, two, preserve their investment. So if you see that the property has made a significant return for our investors and they've been able to participate in the gains and they're going to be whole, we definitely will make that consideration, and then that's when we decide if we want to exit. For example, the View at St. Andrews, before we exited that deal, we projected 18% average annual return, and we observed that we could give the investors almost 30%. At that point, they've already benefited from the depreciation, and the upside is almost close to double of what we projected. So at that point, it just makes sense to exit. So that's why we exited on that deal. So again, our decision is based on how can we make sure our investors are super excited about our exit. But no, they don't have a voting right.
Hey, Tanny, I guess you answered that question for me. I really appreciate that.
I got you, my chairman.
I was saying the same exact thing as you said, that you know what, our goal is to essentially have you join us on multiple deals over and over and over again, long term. The short-term gain is the least of our concerns, but the long-term ability to continue to collaborate with you long-term so that we can become your preferred investment partner is what we're looking for. So usually we look in to make sure that you as our investor are happy, and that, and sometimes what we've also done is actually done an informal poll of the investors, right, Danny? That's what we've done in the past, like before we exited, just to kind of get a sense of what the majority of investors want, so that we are also carrying you along. So, but in the real sense of it, this is not like a voting rights type of thing. You were trusting us to be good stewards of your hard-earned capital.
These are really beautiful questions, guys. Thank you so much for the questions.
These are great questions. I love it. Are you sure there's no other questions in the chat?
I'm looking at all of them. I'm looking at the chat and I'm looking at the question and answer as well.
Let's make sure that we are not leaving any questions unturned. Oh, I think Jude was asking, what options are there for those with less than $50,000?
I responded to him already.
Okay, fantastic. Good. Okay.
But if you want, you can
No.
respond as well.
No, it's okay. Yeah, if you're responding, I'm fine with that. Excellent. Any other questions? We're already over time anyways. I just want to be respectful of people's time, so I think I'm gonna call it. Everyone, we really appreciate you for being here today. You could be anywhere else in the world, but you're here with us. It means a lot to us, and we don't take it for granted. We look forward to you joining us in this property ownership group of Grove Parkview, and we look forward to doing more and more of this with you and growing stronger together as a community. But we cannot wait to close this deal and continue to take on more and more of these properties with you. I think somebody just asked one more question, and I'm happy to answer it because I don't want to leave any stone unturned. Was that Taju that asked, do you have long-term investments greater than 5 years? Yes, in some cases we have done that, where we have done 7-year-olds, even up to 10-year-olds. But this particular one, the projection is 5 years because we do believe that we can provide great value to you and provide fantastic returns for you, even within that business plan timeline. So, but yeah, sometimes we do long-term investments, and eventually at some point, we're actually going to probably mix it up a little bit. We'll do some short-term, some mid-term, and some permanent holds where we just hold forever, you know, and just cash out refi, send the cash to the investors, and keep them in the deal so that we can do buy and holds. But we, just like you are in different journeys of your investment journey, we at Excite Capital are also going through an evolution. At this stage, we just want to grow the wealth of our investors as quickly as possible and get it back to you so that you can make a decision as to what you want to do with it. But we will continue to evolve over time.
And Felicia is asking about a question with less than 50,000. So for folks that are looking to invest less than 50,000, we have to discuss with you to see your situation. Our minimum investment is 50,000, but we could give some exceptions based on the conversation that we have with you. So I recommended that you reach out to our team. Let's understand your situation first before we can possibly do that. Dr. Oni would have to do a sign off on that before we're able to take anything less than 50,000. So if anybody have less than 50,000, please reach out to the team, and we'll be able to discuss with you on what your possible options are. All right.
Absolutely. That's the same answer I would have given also. Yeah, there's been times in the past where we've made an exception. We'd prefer not to. We prefer to just, because we want this to be worth your time. We want it to be worth your energy. And we also, the more investors we have on the deal, obviously that's a lot of work to manage a ton of investors. So we always want to, but obviously our people in our community, we love you so much, and we just want to make sure that you are able to participate in whatever ways you can. So we usually make some exceptions sometimes. It all depends on the situation. So feel free to reach out to us, and we'll take it from there.
And there's a lot of questions just coming in, Chama. It looks like we're going to be at 9 o'clock. There's another question from Anela about, to clarify, if the law changes, one could potentially accelerate depreciation on the entire amount of your investment in 1 year.
So typically it's not the entire amount of your investment, right? So because it's not like you put in $100,000 and then you can depreciate all $100,000 automatically. There's something called the cost segregation study that we have to do first. And this is, for those that don't know, it's a process where we bring in an accountant and a structural engineer. They usually make up the cost segregation team, and then they go through the entire property and depreciate everything besides the land and the building. And they once they're done with the depreciation and figure out what could be depreciated, then they come to us and tell us, okay, this is the number you could depreciate. The of $100,000 investment, usually, I mean, I've seen as high as $60,000 in depreciation, but it usually ranges anywhere from $30,000 to $60,000. And then you could, in the past, when you could accelerate all 100% of that $30,000 to $60,000, you could literally take all of that in the first year. But now you can only take 60% of the amount in the first year. And that's what we are talking about. But if Congress was to pass that law and we're able to accelerate 100%, then you'll be able to accelerate 100% of the depreciation that the cost segregation experts give to us.
Perfect, Chairman. I couldn't have been able to answer that question.
So what happens when you sell after the cost segregation and the recapture? So when we sell, there are ways that you can reduce your recapture exposure. And a lot of times we have 1031 exchanges where you could 1031 into another deal so that you don't capture, you're not exposed to the capital gain taxes. But there are unique ways where we could do it. We could definitely talk to you about that, Chinedu, whenever you get it, when that time comes, or if you want to know about it, even before the deal. Just reach out to us and we'll get it done. Any other questions?
I think that's it.
Fantastic. Okay, fantastic. So finally, and interestingly, a good number of people are still on. People just don't want to leave. I love it. That means y'all are so engaged and y'all are ready to reserve your slot. So quickly go do it before this fills out. By the end of the week, we make this public and it's going to fill out quickly. But we look forward to having you all on this property ownership group. We can't wait to go on this journey with you. Let's go win together. Let's grow our minds together and grow our wealth together. Thank you so much. Have a beautiful night.
Take care, buddy.